All right, so I'm going to start the weekend report by looking at some weekly charts. Got the S&P here as the first one. Um, Looking at the long-term picture here, this does not look like to me that this is a beginning of a new intermediate cycle. Of course, that would be the fears that we've got a new intermediate cycle that topped on week 5, and I would think even if we were in a bear market, that would be too early for a top. So I continue to think the correct count is that we're in a intermediate and yearly cycle decline, and we need to have a C wave down. And I've gone over this in last weekend's videos that almost all intermediate declines have an A wave down. So this would be the A wave. They have some kind of bounce, whether it be several days or several weeks, and then they undercut this initial leg down. And so my feeling right now is that that is what is happening. We've got our A wave down in February. We've had about a 5-week bounce. That's the B wave counter trend move, and we're in the process of moving down to undercut this low. And then once we do, that's going to be our final yearly cycle low. The picture is a little more clear when I look at the Dow. It never even managed to get back above the 10-week moving average at all. And an intermediate rally, even if it's in a bear market, really should at least get above this moving average for several weeks. And the Dow didn't do it. So I think that is, I think we have the correct count. This is a move into a yearly cycle low, and we're in the process of moving down into the C wave decline that will break below this February low. So again, this just does not look like a new intermediate cycle that has failed on week 3. And as I went over in my one of my videos from last weekend, I think the reason this is becoming so severe and chewing up so many weeks is simply because we've just had it very easy ever since the election. The market has gone almost straight up. Intermediate degree corrections have lasted all of like 2, maybe 3 weeks. They've all been very mild, rarely dropping for more than a week or two below the 10-week moving average. And so we're paying the price of this year and a half of very easy, one-dimensional, one-way trading. We've now got to pay the price. And I suspect that when we do get this undercut low, I'm gonna say that the first daily cycle out of this, when we do get this yearly cycle low, is probably going to be a little bit different. And this again leads back to this period right here, a very low volatility, one-way trading. So what I think is going to happen is when we do get the low, I suspect we're going to chop around rather than a slingshot move right back up to test these highs. I suspect we're going to have some difficult trading for maybe the next 2 or 3 months where we just chop around. And it's possible that when we do get the next intermediate cycle top, it may not go very much above this January high. So we may get something that looks like this maybe during the first part of the year. And remember, we had an intermediate cycle low that occurred in August, and so we may have another intermediate cycle low in that same timing band, maybe August or September. So we may not get what we're accustomed to, and that being just a rocket launch out of the bottom straight up to take out the previous intermediate cycle top during the first daily cycle. Just may not be that easy this time. we've come a long way over the last year and a half with no volatility, and we're probably going to have to pay the price, and that probably means this once we do find our bottom, um, probably as an undercut, then this next intermediate cycle probably just isn't going to be quite as easy as what we've become accustomed to, and it may be that all we do is manage to come up and retest this high, and it may take 3 or 4, 5 months to do it. There may just be a lot of choppiness on our way up to test this high, and then another intermediate degree sell-off in maybe in August or September before we can break out of this and start the next leg up. And I continue to believe that we are going to hit 10,000 on the NASDAQ before this 4-year cycle tops. But at this point, the odds are very slim that we're ready to get a parabolic move. And now I would say the odds are probably 95% that we are in that long-term secular bull market mode. So we've got another 10 or 15 years to go, and we've come a long way, and so we're going to have to pay the price for several months here of difficult trading before we can start another trending move up and take the NASDAQ up to that 10,000 level. So I've shown this chart before. We started the move after the elections at about 5,000. I think we probably have a T1 pattern in play. We've gone from 5,000 to 7,500, so we made it about halfway there to 10,000. But it just looks to me like we're going to need longer in this midpoint consolidation phase before we're going to be ready for the next leg up. That should roughly match the 2,500 points from 5,000 to 7,500. So we're going to need to spend more time in this midpoint consolidation box than just one quick move down and then we're off to the races. And that was when this breakout above 7,500 quickly failed, that was a big warning flag that it was time to take our profits on all of our positions and get on the sidelines. And that was a signal to me that this consolidation box was going to be longer and more difficult than what we had hoped. So a couple of potential targets for this yearly cycle low to bottom. Friday was day 29 of the daily cycle. A normal cycle runs 35 to 45 days, so we probably have at least a couple more weeks before we want to try and pick a bottom. And a couple of targets. The most likely one, in my opinion, would be this 38% retracement of the entire move so far out of this 4-year cycle low. That would be a little below 2,500, somewhere in the, I know this, that says 2,464, but I didn't measure this exactly. I think the exact number is somewhere around 2,480. So that's probably the most likely spot for this to bottom. And if we are near that level here in about, let's say 7 to 12 trading days, then, very good chance that might be the bottom, and that might be where we might take a shot at starting some initial positions, maybe in that first week of April. Another, if we were to slice through this level pretty quickly, say in 5 or 6 days, then we might even look at the 100-week moving average down here, somewhere around 2,400 before we try and pick a bottom. But right now, too early to start trying to pick a bottom. Monday's only day 30. Minimum, I think we got to go at least 5 more trading days. So, next Friday would be the absolute earliest, in my opinion, that we could expect a bottom. And I'll show you on the sentiment charts something that I would kind of like to see happen. Um, and in order for that to occur, I think we're going to have to at least go to the 38 and maybe the 100-week moving average before we get our bottom. So no big hurry to try and pick a bottom just yet. Probably, no need to try next week, next Friday at the earliest. Markets don't usually bottom on Friday, so I'm going to say probably Monday or Tuesday of the next week is the absolute earliest we could, start looking for a bottom. Now here's something I wouldn't mind seeing happen if we were to get, to continue this hard sell-off over the next 5 to 10 trading days. If we could see the robo ratio shoot up and tag this excessive pessimism level, that would be a very good indication that that we're at or very close to our yearly cycle low. All right, the next market is the dollar, and last week I'd noted that we had closed above this 10-week moving average. That could have possibly be a signal that this was an intermediate bottom here, but this week we've closed right back below it, and it's still a bit up in the air, but as of Friday, it's beginning to look like we've got another failed daily cycle, left translated daily cycle in progress. It won't confirm a failed cycle until we move below this low here. And let me change this to daily so we can look at the daily candles. All right, so as of right now, the dollar is holding below the 10-day moving average. Right now, our top occurred on day 8. That would be a left translated cycle. Next week, we need to start, we need to break out or downwards out of this consolidation box that it's been in for several weeks now. The dollar needs to break down below this level, get down here. If we take out this low, that would confirm that this is a left translated daily cycle with a top on day 8. And if the daily cycle left translates and we break below this daily cycle low right here, then I think that gives us that move down to tag this long-term bull market trend line. And then at that point, I think we could get a more realistic bounce, something more sustainable that looks more like an intermediate degree rally. And right now, this does not look like an intermediate degree rally. It looks more like a bear flag. So that's what we're going to look for next week is we need to see some follow through to the downside in the dollar, and that would let us confirm that we've got a left translated daily cycle in play, and then at that point we would expect this to break and this trend line to get tagged. And assuming the dollar does what I'm looking for, then the cycle count on gold is really fuzzy right now. It's really difficult for me to tell where we're at. A case could be made that this was an intermediate low right here. The problem is it's on week 11. That's really too early for an intermediate low. This was a failed daily cycle, but I think the correct count is that we're on week 14, and assuming the dollar gives us that failed daily cycle and moves down to that trend line, then we get a push up over the next see the dollar's on like day 22, and those cycles can last up to 40 days. So let's say we've got maybe 3 to 4 weeks maximum for the dollar to move down and find that next daily cycle low, which would also be an intermediate cycle low, and that would potentially give gold another 2 to 4 weeks to rally. And if we could break above this high here, then it would turn this entire intermediate cycle right translated. Right now we've got a top on week 8, which is a left translated cycle, and we've got a fuzzy intermediate count with this possibly being some kind of weird week 11 intermediate cycle low, but I don't think it is, because I think the dollar is going to, if it does roll over and give us one more left translated cycle, then gold probably only has for however long it takes the dollar to tag that trend line to rally. So like I said, we're back above the 10-week moving average here. That's a good sign. I think the correct count is week 14, not week 3. And I tend to believe that we're going to come up and test the baby bull. And let me widen this out a bit. All right, so here's the baby bull at about 1377. If we can get 2, 3, maybe 4 more weeks in this intermediate cycle, I think gold has a chance to test this, maybe even test 1400. And then at that point we get a top on, let's say, week 16 to week 18, and then we get our something that is a more recognizable move down into an intermediate low as the dollar rallies. And then moving on to the mining stocks, the GDXJ managed to close above the 10-week moving average. That's a pretty good sign. We've had a lot of weeks here, 4 weeks of just kind of churning sideways. The risk was that this churn could break downwards like it did here. You can see 4 weeks of churn over here, and then the break was to the downside. We've got 4 weeks of churn here, but it looks to me like we're breaking to the upside here. And hopefully, if we can get a test of the baby bull over the next 3 or 4 weeks, then we've got potentially maybe 2 to 4 weeks for the miners to rally. I think they could. I think GDXJ could, at least test the January high. Maybe an off chance it might test the September high during that period. Not quite as bullish of a look in the GDX. We haven't closed above the 10-week moving average yet, but it does look like this sideways chop is breaking to the upside. Very similar to the junior miners, and where the junior miners lead, you would think that the majors would follow. So it looks to me at this point that this consolidation box is not going to break downwards like this one did. Looks like it wants to break upwards, and potential to test the January high and maybe even the September or February high from last year. I don't, however, think we're out of the woods yet. I think this basing pattern is probably going to continue. You can see here we've basically just been bouncing along this 200-week moving average here for almost a year and a half now, and even if we do get a rally enough to test one of these highs here, I think we probably have another move back down to test this 200 again during what I would assume to be the next true intermediate degree decline when the dollar does finally give us an intermediate rally, and gold produces something that looks recognizable as an intermediate bottom. So I don't think we're ready to take off and go to the moon just yet, but I do think there is potential to possibly at least get a tradable rally that could maybe take us back up to the 25 to 26 zone over the next 3 or 4 weeks.